Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, or regulatory landscape and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site, we have Chris Dearborn, Managing Director on the Nasdaq Market Intelligence Desk, Dave Dziekanski, CEO and CIO of Quantify Funds, as well as Amy Zhang, EVP and Portfolio Manager at Alger. We're here to discuss what areas of the market stand to be more resilient through economic and geopolitical uncertainty, and it's great to have everyone with us. Amy, that really is the theme of the day, is just the machination with the headlines and the market trying to work through a lot of uncertainty, to say the least.
Yeah, of course. But as you know, we always have said that we invest in motorboats instead of sailboats. So as you know, we always look for companies that have idiosyncratic drivers. The motorboats can propel themselves forward regardless of economic, backdrop and geopolitical risk. So for us, one area is very exciting. I think it's really underrated, undervalued, is healthcare, especially diagnostic testing area, like companies who can reach great clinical outcome for personalized medicines through diagnostic testing.
Yeah, well, it's interesting. When we were at CES, the Consumer Electronics Show this year, health care as it relates to diagnostics and health tech was such a huge topic at the event itself. Are there areas in the market that, because these valuations have really come back in line, things are looking attractive? Because fundamentally, some of these companies, there's nothing wrong.
No, there's nothing wrong with them. I think the whole world is trying to figure out how to plan their businesses for the next 3 years with so much moving targets on trades and tariffs. And so it's really hard to come up with a good plan of how your business is supposed to execute it for the first couple of years. We hope that that's really going to be a short-term phenomenon. We're getting a lot of this out of the way in the first 6 months of the year and add some more clarity to businesses in the future. I do agree that, especially in the genome space, a lot of artificial intelligence will apply there. We just launched 4 growth-related leverage ETFs last week that focus on larger cap growth names, both in the AI and crypto space. We think those will also bounce back, and there's a nice, even if this year ends up in the red, there's so much pessimism right now that it feels like there's an opportunity, at least in the next 3 to 6 months, on everything from the mid-cap space to the mega-cap names and everything in between.
Which is so interesting, because you would think investors would shy away from levered ETFs when the market's especially volatile. The funds flows have been pretty strong going into levered ETFs, especially with the mega cap names.
They have been. This year has been a little bit weaker. We've seen more flows into Treasury and VIX related leverage ETFs this year than we have any time in the past. All of our funds are what we like to call leverage for the long run. So these are not daily reset products. We take an institutional process called portable alpha, stack 2 different assets on top of each other, and there's a mechanism of rebalancing that happens within the portfolio that allows it to not be just intended for daily use. We have an AI one with the ticker APED. We have AI one with Spicy and Lays, SPCY and Lays, that both pair NVIDIA and AMD and NVIDIA and SMCI, as well as a cryptocurrency one that pairs MicroStrategy and Coinbase with a 200% exposure between the two, and does a lot of the rebalancing that people tend to not do on their own, all built in within the product. So we think this is a new evolution of leverage ETFs. It's using what is called portable alpha that was initially launched by PIMCO, if you remember those Stock Plus funds way back when, and you're seeing a whole category grow in the ETF space of this new capital efficient strategies, leveraging 2 different assets on top of each other, allowing for some rebalance. So we call this institutionalized leverage ETFs.
Interesting. It's so cool, what they could put in wrappers these days. Chris, so on the Market Intelligence Desk, you're talking to our Nasdaq listed companies all day long within the consumer and retail spaces. Any trends you can discern from conversations you're having with management?
Headline risk across the board, no doubt, right? And investors are really not sure what to do with it. So you're seeing the momentum players take the path of least resistance in the markets, and that trend is down. If you look at some of the smaller indices that follow space, the S&P 600 retail index is down over 11% in less than 10 days. The Russell 2000 as a broader whole is down about the same. It's down 17-18% since the November peaks. You're down 10% in a couple of days, getting that correction period. A lot of the companies, especially the small names, are coming out with earnings nowadays, and some of them are gangbusters. They're really doing well, but to sell the news event. One of the CEOs I spoke with today actually said, we gave out fantastic numbers and guidance, yet we're down 13% in the market. He goes, I don't understand why. I go, and your volumes are light as well. which tells me that nobody's stepping in to buy these names on strong growth because of the uncertainty. Nobody's walking away from them. You don't see institutional shareholders selling their positions out, but there's nobody stepping in to add or grow new positions. Basically, it's risk off, and if you look at the VIX at 27, 28 right now, it's telling you everything you need to know.
Right.
Even though that's based off of the S&P 500, nobody's stepping in to catch this knife until we have certainty.
Right.
Because you can put your money somewhere else right now, especially in treasuries.
And Chris, part of it too is once you have volume being sucked out of the market and liquidity, not that it evaporates, but the liquidity profile changes, it's going to exaggerate a lot of those moves as well. And that's what we've seen. Amy, coming into the year, you had told us this could be the golden age of small and mid caps for 2025. Does that thesis still hold?
I still think so, but I feel we're in the darkest hour before the dawn to see that ray of light. So I think it's probably going to be a bit of back and loaded, since we're already in Q1. But it's almost like, as you know, we are active managers, stock pickers. I've always used volatility as our friend. I think, just like you said, Jill, especially in small mid-cap spaces, the volatility is really amplified. So it's really stock tend to overshoot a lot, and nowadays it's more on the downside, right? And they have, so to that extent, I think this is really a great opportunity for us to plant the seeds. Because, for example, small cap, US, the kind of company we invest in, secular growers, healthcare companies, they are really very insulated from tariffs and the geopolitical risk, but they're still getting sold, like, for example, yesterday, right? So it's really about throwing the baby out with the bathwater, and I think that's really great opportunities. I always believe there's crisis as opportunity.
Yeah, well, with the small cap space too, particularly for those that have manufacturing and operations in the U.S., depending on the tariff structure, that could be a tailwind.
Oh, exactly.
For them.
Absolutely, especially in healthcare space. Like one of the company we really like, GeneDx, they actually use exome and genome to sequencing and test, to diagnose rare disease. And they have 100%, it's U.S., U.S. based and U.S. revenue and generation. So they're in a very nascent stage, and with very small revenue base, only around 300 million last year, and a 45 billion, potential market, because they start with pediatrician, and then going to go to NICU, and then they're going to go to adults. So it's very long run. They also use AI, turn data, machine learning, turn data into actionable insights for the interpretation platform. So things like that, a stock like that, it's been very volatile, but I think it's tremendous alpha generating opportunity there.
It seems as if that kind of space would be insulated from it. You're not going to stop treating. Pediatrics.
Yeah,
I think its business models should be insulated, but as we've all pointed out, there's just such a lack of clarity of what the whole investing landscape will be like over the next couple of years that, again, it's our hopes that a lot of this is being jam-packed into the first half of the year to have as small of a period of confusion as possible with some clarity in the back half of the year.
Which is interesting because Trump 1.0, we didn't start to see these scenarios until the middle of it, right? So at least we know, okay, here's Max Payne, if you will, hopefully, right? I mean, that's an interesting scenario, Chris.
It is, but you still have to look at a number of items. Last week was one of the worst weeks for stocks across the board of the year. But we did get a relief rally on Friday, and that came after Jerome Powell's comment saying that he thinks the economy was okay, right? But we'll see what the data says. And that's nothing that hasn't changed. We get CPI tomorrow, PPI, and then retail sales. Retail sales for January, which came out last month, were awful. It sent a real scare into the markets on the consumer side. So if the consumer's not spending, then there's a lot of growth concerns. 2/3 GDP is consumer spend, as we all know. So that's really a concern there, which is bleeding over to a lot of other companies. Again, job market is definitely softening to a point, but it's not weak by any measure. Wage growth is still there, but not tremendous, what we've seen. And will the consumer continue to carry the economy on their back? That's the bigger question. That's why people are shying away from volatile equities. I mean, if you look at the Russell, 40% of the companies are cash burn. So you're not sure where you want to put your money yet. So people are trading the trend if you're near-term investors. That's why you're seeing the volatility in the Mag 7 and the S&P 500 and a lot of the others. The investment opportunities are absolutely there. It has a feeling to me a little bit like COVID, where it's just fear upon fear upon fear. And it was one of the best buying opportunities we've had in the last decade. For equities. So it's definitely there, but I don't think we've hit the bottom yet.
Dave, Chris makes a great point, and our U.S. economist was on last week saying the same thing, where the economic data isn't necessarily reflective of the noise in the headlines, right? Unemployment rate from 4.2 to 4.1, or even a couple, more tenths in between, that is not a scary metric if it moves around, just by a couple basis points.
But I think, as we alluded to earlier, even when companies come out with good guidance, the street is not necessarily even trusting that guidance because they don't know if their inputs are correct on that side. I think Trump 1.0 very much measured himself by the stock market, and Trump 2.0 is now trending towards the deficit and Main Street, right, and not as much the overall top line level of where the stock market resides today. Could that change in the second half of the year? Absolutely. Could he feel a little bit of pressure if volatility brings us back a little bit further south from where we are here today? Absolutely. But it feels like it's a totally different regime versus 1.0.
And Chris, you and I have spoken about this a number of times on the desk where, and I've brought up this point myself, if Trump 1.0 is any indication, he benches himself on the economy, the market, and U.S. leadership. I got that wrong.
He came in with an agenda. And
Which is different.
Which is very different, and he surrounded himself with folks who are going to enact his agenda. And whether it's the reduction of the deficit, which seems to be first and foremost, the tariff part of it is just part of that plan. Everyone needs to pay their fair share in his mind. So that's just going to continue to play until he gets what he wants. We don't know exactly what he wants. I don't think he knows exactly what he wants, but he knows where he wants to get to. And whatever he has to do along the way to get there, headlines intraday, change of policy the next day, who knows? The markets are rallying a little bit here now on the Ukraine 30-day ceasefire, which just got signed midday. So it's turned it around. But if you look at the general breadth of the market, it's still in the high concentrated names, the Mag 7 that carry a lot of market cap weight. Yesterday was one of the worst days in the S&P 500 for this year. But the breadth wasn't that bad. It was a 2.5%, 2.6% decline, but the breadth was 335 names out of the 500 declined, and a lot of them were very small. Today, the Nasdaq 100 and the composite are up as we started this show, and the breadth is negative. So it's telling you that it's still market cap central for the larger cap names that are trading off the headlines.
Right.
President and the future will have their moment moving along, but again, until there's clarity, and again, tariffs are just headline grabbers for the moment. It takes months, if not years, for tariffs to kind of trickle through.
Right, of course, too, but if you have to also, onshore, move your manufacturing processes and so forth, that is not, that's billions of dollars of investment. It takes 3 to 4 years
what he wants is campaigned on. He's doing pretty much everything he said he campaigned on. Onshoring, creating jobs, everyone pays their fair share. I will broker peace deals across the board.
See, but that's where I think David makes an interesting point, where from day one, this is being done. So it's not like 1.0 where it was December 2018 and 2 years into the administration and now we're trying to figure out how it works with tariffs. At least the news is out there. And you know what to expect. That kind of removes some of the uncertainty if you think of it in that perspective.
Oh yeah, definitely. I think this is just a very painful period, but it's a period of de-risking. So if you were, of course, this is our country, but I think if a company is like, you will call it's kitchen sink it, right? To low expectation, doing everything the administration want to have build a strong country. So every other measures is try to set things up for the intermediate and long term.
Right.
When this year, the rest of 3 years and beyond, I think.
I think that's a great point that you make. And David, I think part of the challenge is too, everybody wants immediate results. There is no long-termism. We've gotten conditioned to buy the dip. We've gotten conditioned that liquidity will be there. The market won't go down. We won't let an economic cycle happen, and patience needs to be exerted.
Yeah, buy the dip is almost a religion at this point.
Right.
I think people are trying to, as you pointed out, assess what is actual policy being put into place and what are negotiating factors right now. So our first ETF is the leveraged Bitcoin and gold ETF, BTGD. That's the trade that Doge isn't able to get their job done as well as they think, right? It's scarcity assets with low replacement rates. Bitcoin got absolutely slaughtered in the last couple weeks because of the overall lack of liquidity in the market, and it is a barometer of overall liquidity in the overall market. But again, as we talked about, we hope over the next 2 months, we see some clarity. What is a negotiating chip? What is actual policy trying to be put into place? And I think we keep swinging between those two extremes right now. And then good guidance will actually be a positive thing for stocks in the future because the street will actually be able to trust that guidance on the outlines of the economy as we expect it to be in the future.
Well, because they will understand their operating environment.
Right. It's hard to model out when you don't know what the inputs are going to be. and you can't do it successfully. That's why you see the haircut in a lot of the companies that are coming out across the board. However, that is bringing valuations down. Valuations have been very, very lofty for a very long time. So some of the valuations are still very lofty, especially on a PE level for a lot of these companies. However, they're a little bit more in line where we were 6-7 months ago. The question is that enough to entice buyers to come back into the market? I don't think so until there's clarity.
Yeah, but it goes back to valuation again. And regardless of geopolitical risk or uncertainty with policy and tariffs, that is why Europe was outperforming U.S. markets, because it was a valuation story.
Right.
So it's not like fundamentally anything, it's changed.
Tina's been thrown out. It's part of the sink with the baby in the bathwater. Tina's out of there because there are now other alternatives.
Right, and that's the whole thing. It might, regardless, even if we knew what the operating environment looked like, that was the trend. You were looking for value plays because, January was a pretty decent month. Europe outperformed.
Yeah. That's a great point. And I feel the same way about small mid-cap stocks because the valuation, small mid-cap index, they are trading at close to 30% discount to S&P 500. So it's just really a matter of time. Like, I really appreciate you saying patience is very important in small and mid-cap.
Well, especially mid-caps are always overlooked.
Right, exactly.
So I don't think people consider fishing in the mid-cap space looking for valuation. It's either Russell 2000, S&P 500, Nasdaq 100, and there's no in between. Whereas there could be great opportunities, the contrarian play. Look at the mid caps.
Mid caps are much more as a whole profitable than small caps. The percentage of companies with zero negative profit in the Russell 2000 is absolutely astronomical, and mid caps is almost like a quality screen on small caps with a higher likelihood of being included in the S&P 500 from there. So.
Oh yeah, we already have many companies included S&P 500, sort of nice graduation. And yeah, just like you said, it's the best of both worlds, right? It's a quality, higher quality than small cap, but also still has a lot of discovery value because still under covered by a lot of analysts compared to large cap and mid cap, but it's much more liquid and it has significant growth potential.
That's a great term, discovery value. I'm hijacking that one. Chris, final thoughts.
The markets have been oversold here. It's across the board. The question is when it's going to stop. There's definitely going to be a V-turn at some point, but it's not going to come to this clarity from Washington.
All right. We'll leave it on a positive note. Appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.